of November 2014, there was a meeting for OPEC. And at this meeting, they are trying to find out a resolution to meet the market surplus of the oil by reducing the production. But unfortunately, it was collapsed. One day after, the oil price and oil and gas companies' stock price was collapsed. At this time, I asked myself, how to help the individual investor in the stock exchange to choose a company A rather than company B. That's why I asked myself 4 questions. And those were my research question. First one, in the oil and gas industry, in the accounting for the oil and gas, it has 2 main methods which are used in the oil and gas accounting. What the effect of the different applications of both principles on the stock price? This was the first question. Second, how to exploit the different valuation techniques to evaluate the stock price of any oil and gas company, because we have many different techniques. Third, as you know, doctor, we have some oil companies focused on oil production, and others focused on gas production. And few of them, they have a mix between oil and gas. So my question here, what the effect of the different production mix strategy on the stock price? Fourth and last one, I am talking here in this paper about the US market. If any company has investment on the international market, is there any effect of that on the stock price? These were the 4 questions. Actually, my paper is based on 3 chapters. Chapter 1 is give a brief explanation about the accounting and disclosures for oil and gas. Chapter 2 explains the different techniques which can be used to evaluate any stock price. Chapter 3 is some sort of an empirical studies and choose many samples of oil and gas companies and try to test the different valuation methods. We can start now with chapter 1. Chapter 1 will cover 3 main areas. First, the accounting. Second, the disclosure for oil and gas companies. Third, the fiscal system. When we start with number 1, with the accounting for the oil and gas, we have first to identify the 4 major costs, which is number 1, the acquisition cost to acquire rights. Number 2, the exploration cost, the cost for finding out the oil and gas. Number 3, the development cost to pump up the oil from subsurface to the surface. Number 4, the operating cost. For the 2 main methods which are used in the US market, we have the full cost method and we have the successful effort. Both of them are treating the different cost type the same, except only the exploration cost. Exploration cost, we have the drilling exploration cost and non-drilling exploration cost. Under the full cost method, the oil and gas company capitalizes the whole exploration cost and put it on the balance sheet, and then is depreciated based on the production. Under successful effort, only the non-drilling cost will be expensed as incurred, but the drilling cost is based on the result of the drilling. If it succeeds, it will be capitalized. If it's failed, it will be expensed as incurred. So the effect on these methods will help me in one of the valuation techniques when we explain later. Second one of chapter 1 is the disclosure. The disclosure is very, very important thing for any investors to understand the disclosure of companies. We'll cover only 2 points here. The point 1, the proved reserves for any company. In the disclosure for proved reserve, I can have a reconciliation between the beginning period and the ending period, and I can see what difference between both reserves. It's come because of new acquisition, new exploration activity, production, anything. I can judgment the company on this item. Second one is very important, it's called SMOG report. SMOG stands for Standardized Measure of Oil and Gas. It's the discounted net cash flow of a company based on specific rules, and the whole oil and gas companies in US using the same rules. So it's very good to make a comparison between companies based on this item. The last one in chapter 1 is the fiscal systems. And fiscal systems talking about the collection or payment from the governments to the contractors or the oil and gas company. We know in US, doctor, the oil and gas company owns the surface rights and the subsurface rights, owns the reserves. But in the MENA, like the MENA, the oil and gas company doesn't own the reserves under the earth. Only it has the right to produce, and the company can take back its money based on cost recovery method. Okay, doctor? This was chapter 1. Chapter 2, it talks about the different valuation techniques, and actually in this paper I will use the fundamental school. I started first with the rational theory of rational expectation and then the efficient market hypothesis. And then starting for the different valuation methods, I took brief about the discount cash flow and how to use the dividend discount models and the market multiples. Actually, this was chapter 2. Chapter 3 was the most important one, and if we can open page 64. I started in this chapter to answer my questions. My first question was, what the effect of the application of different accounting standards on the companies of different size. I choose 4 companies, 2 at medium size and 2 at small size. Each one uses different method, and actually I couldn't find any large company or giant companies. It's all using the successful effort, and check what the effect of the different application of the accounting. Actually I found that under the full cost method, the property, plant and equity, which is the PP&E, takes a big portion of the balance sheet, which is normal because everything is capitalized, right? But under successful effort, it takes a smaller portion, and as a result, the DD and DA, the depreciation rate, was very, very high for the full cost companies because everything was capitalized, so the DD and DA was very high as well. This will help me, doctor, when using the market multiples. There is a multiple called the EV divided by EBITDA. Under successful effort, the exploration cost is included in the income statement, but under the full cost method, it's not included. So it's not comparable. So I have to eliminate the exploration cost from the income statement or from the EBITDA under successful effort to take the EBITDA X. So it's now comparable. That's why the first important thing. Second question, how to exploit the different valuation techniques. First, I started to determine the discounting factor which will be used. I used the capital asset pricing model because the WACC is not applicable for the individual investors. And then for the discounting cash flow, I couldn't determine it or calculate it because it needs insider information. I used the smoke report, which I've said lately about the smoke report, which is some sort of discounting cash flow. And then divided by the common stocks. I found something. I choose 2 types, doctor. One, the exploration and production companies, and second is called integrated oil. For E&P companies, doctor, I found that when the oil price is very high, the stock price, the closing stock price, and the valuation price is very close together. But when the oil price is very small or very low, it's misleading. Misleading. For the E&P company, for the integrated oil doctor, I found whether then the oil price is very high or small, it gives me a misleading results. Because in the integrated oils, it doesn't include only the E&P, it has another activities such as the refinery and the processing, which should reflect something in the stock price. So it's misleading. I used the dividend models for both the normal dividend model and the Jordan growth. And actually, the whole result for the model, doctor, gives me a misleading items, because many reasons, such as the growth rate for the dividend sometimes is more than the discounting factor, give me a negative result, which is not used. Third, I used the market-based valuation multiples, and actually, doctor, this was best one. All the result was in the range, normal range. So I think this was good method for valuation. And then, doctor, I started for the third question. How to answer the third question about the different production mix. I take Oxy as a sample, it gives me the total production as fixed, and I change it between the oil and the gas. Take from oil and gas, but at the same time the level should be fixed, and check the level. Actually, it was a surprise for me, because before I had a belief it's better to invest in oil rather than gas. But the result give me there's a very small difference, about 7% between investing in oil and gas, and I changed my belief based on these results. And actually this was a surprise for me. The last question about the international investment, I took Oxy as a sample because it has international investment and domestic investment in US, and I monitor and watching the difference in the reserve amount while the oil and gas changed. I found that when the oil price going down in US, the reserve amount is go down because of commerciality is different, but in the MENA is going up because of at end you paid X dollars and you have to recover it in front of oil. If the oil price going down, your parents will go up. And this now give me some sort of diversification tool, which is very important to me. And finally, I give my conclusions, which can be summarized that the oil and gas company is heavily affected with the oil prices, and it's very important to the individual investor to understand the accounting of oil and gas, the oil and gas accounting. And the market-based multiples is the efficient tool for any individual investor because it's efficient in cost and time. And the production mix, whether in favor of oil and gas, doesn't have a big effect on the company's earning. And finally, in the conclusions, the international investment for oil and gas company is very important because it becomes a diversification tool against the oil price cycles. My recommendation, doctor, for any individual investors, first, he has to determine what is his strategy in investing. If he is if it's short term, it doesn't make any sense to use the dividend yield. Dividend yield needs long term. So at the beginning, he should choose his strategy, it's short term or long term, to determine which the best method he shall use. Second, he should have the minimum level of accounting knowledge about oil and gas. And finally, if the individual investor wants to invest in oil and gas company, he should diversify this investment against another one because there is oil price cycles. Thank you.
Okay, thank you. A few questions. The first one, you try to study the question in your chapter 3, and you take the example of the USA market.
Yeah.
Why especially this?
Actually,
focusing on USA.
Yeah, USA is it's highly regulated by the SEC, and the whole information, and there is a consistency in the reporting. So it's good to compare between the company and company because all of them are using the same methods, are disclosed the whole information needed by the SEC. That's why I use the US market, because the regulation is it's high regulated. So the disclosure will be high, it's more transparent for the companies, and so I can test my questions based on the quality of the information will be better because I have the whole information I need. That's why I used US market.
Okay. So do you think your conclusions would be transposed to the other markets?
To other markets, doctor, if we can see what is the oil and gas companies, the major oil and gas companies is American or European, actually. Now we can see the China's or those stuff, and now all of them except US are using the IFRS standards. US is going the same, but not now. If I use the same information from Europe, it will give me the same actually, because it's now become more consistent. But not all markets, like we have German and French companies and British. Every country has a different application of gaps till now. The IFRS is just headlines, but not in details like the US. But at the end, it will give me, if I have the same information from Europe, it will give me, I believe it will give me the same results.
Okay. I'm not sure to have well understood your developments about your last point, one of your last points. Do international investments have an effect on the stock valuation?
Yeah.
So can you explain
Yes.
simply what you want to demonstrate?
Before I can go through this, we have to understand what is the different agreements we have. We have something called concessional agreement, which is used in US. Concessional agreement, the contractor of the oil and gas company owns the reservoir, owns it, and just pay the government a royalty and tax. And this concessional agreement. On the other side, we have a contractual agreement, like in the MENA, which is divided in the PSC, production sharing agreement, or contractual service. Both of them are the same, but just the payment to the contractor will be in kind or in cash. But the idea for this is based on, I didn't own the reserves, but only I own about a share of the reserve to get back my money, because I spent first, right? As a contractor, I take the whole risk, oil company, go to UE, I take the full risk, and I start to explore for oil and gas. If I found, okay, I can recover this cost from the government, but to the extent for the money I already spent. So in international, I'm talking about the US company. US company, when the oil price going down, the commerciality of the reserves is changed every time when the price right. So the price going down, the reserve amount will go down. But on the international, like UE, if the oil price going down, I already pay, say, $1 million. I have to recover this amount. So my share in the reserves will increase because of the lower oil price. And this share will increase, so my revenue, my earning will increase. As a result of that, this earning will affect, of course, my stock price. At least in the based on the discount cash flow or in the multiples, it will affect me.
Okay. So to conclude, is it a good idea for an investor to put money on the stock market in oil and gas companies?
Yeah, yes. It's the oil and gas company is a very high quality company. Yeah, it has a risk of the oil prices. That's normal, but it's just cycle, not forever. Of course, we have a strategic, as an oil company, we have a strategic risk now about the clean environment now, the regulations, but they are trying to, something like oil companies now are to develop their techniques in drilling to be tied with the environment, like using here the CO2 now. It's very clean, and actually in US they take tax deductible tax credits if they are using the CO2 to be clean environment. You can use in the oil and gas, but you have, like what we have said in the corporate finance, the diversification. There is a risk, but this is unsystematic risk, which can be diversified by, say, investing in another sector, which is not correlated.
Okay. And your conclusion also is that you cannot make a difference between oil and gas.
Yeah, this actually, I was believing before, there's difference, better to focus on oil, because I see oil 50 or 100, but the gas is 20. But actually in right, the equivalent of oil in gas is every 6 units of gas is 1. So it's 60 by 20 is 120. It's very, very close between oil and gas, and actually I changed this belief now based on this result. That was a surprise for me actually, and I learned from this actually.
Okay, so thank you very much. Thank you.
Thank you. Well, that's all.